welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Niket Shah, Chief Investment Officer at Motilal Oswal AMC. Welcome, Niket.
Thanks, Suchira, for having me here.
To begin with, can you please share with us what inspired you to dive into the equity markets?
Yeah, so I think it's a bit of a long story. So I started, in 10th standard, in fact, to look at equity markets, and a large part of that was primarily because of my dad. So I was very much into sports before the 10th standard and had no interest in equity markets. But my dad took me to his local broker because he was a chartered accountant and he used to invest in equities since a long time. But he was typically a very, very longer term investor. So he took me thinking that let me teach him, because any which was in vacation, he has no inclination towards studies. So let me teach him something about equity markets, how stock market really works. And he took me to a stockbroker a couple of times, which was in his building itself, in his office building. And I actually saw people making reasonable amount of money in just like matter of 1 hour, 2 hour. And I thought this is this is pretty fascinating, right? Because without a plant, without any business, people are just coming into equity markets, investing and making money, right? And my dad then said that, why don't you also look at this and learn from it, right? So I said, yeah, I mean, why not? I mean, this sounds exciting. It looked so easy at that time because there was only 2 or 3 days where I went with him. And virtually it was a bull market of 2004 to 2008. Everyone was making money, right? And you buy in the morning and sell in the evening, you used to make money. And then he said, okay, I'll give you 5 lakh rupees and let's start. Okay, so you learn at least. And he told me, do investing, okay? And do long-term investing. But I thought, yeah, मैंने तो long-term investing देखा नहीं था. I saw people who came in the morning and bought and sold, and they make tremendous amount of money, right? At least for those 3 days where I was there. So I thought, yeah, let's start with that only. Yeah. Let's not do this long-term investing thing, right? And I started, investing that 5 lakh rupees, thinking that I'll buy today in the morning and then sell in the evening. This is what my thought process was when I was in 10th standard and kind of quite amateur and had no idea about stocks, no idea about what companies used to do. So what typically I used to do, I used to go to the broker at that point of time and used to ask him, yeah, you tell me 2 or 3 good stocks, whichever to buy. And at that time, whatever used to be the flavor of that day or flavor of that month, he used to go and tell us, Gary, acha hai, because 4-5 good guys have bought it and so on and so forth. And I landed up buying some of them. Right. In the first couple of transactions, you end up making money and you feel, yaar, this is like the way to go, right? And then what happened in that journey is that you buy and sell, You at the end of the day, over a period of 1.5 months, I lost that entire 5 lakh, right? And I went and told my dad that, hey, I lost that 5 lakh rupees, what you gave. But now I learned how to do it. And, I'm very, very confident that now I have understood the tricks of the trade. So he said, first of all, don't do day trading. I told you to do investing, but why are you getting into trading mindset? So I said, yeah, because everyone else was making money, I thought this is how, I can also make money, right? He said, no, but you have to do long-term investing, right? He again gave me another 5 lakh rupees to invest, right? And I said, boss, first, let me recover that first 5 lakh, which I lost. And then we'll start from square one and then we'll do long-term investing. Little I knew that I actually lost that 5 lakh doing the same thing, same mistake that I did in the past, right? And I lost 10 lakhs and I told him, boss, he said, boss, I don't have any much, I don't have such a large capital that you keep losing every month and you keep coming to me. So he said, I'm not giving you any more capital, right? And I realized that, look, I've lost 10 lakhs in 10 standard, and that's a very, very bad start. But it actually got hooked me on to equity markets by that virtue, right? So that's how I started. And then subsequently, after 2 years of break, I think for till 12th standard, I didn't do any investment. I just used to follow markets because even I was damn scared because I lost 10 lakh rupees from my dad, which was a very large sum at that point of time because he was just a practicing chartered accountant. And whatever savings he had, he thought I'll invest and learn. But in matter of 2 or 3 months, I have ensured that, the 10 lakhs has gone to zero. So then effectively after 12th standard, I said, like, I will give you an idea. If you like it, then you invest yourself. Don't give me the money because I'll do the same mistake maybe again. And I then gave him a couple of ideas, which I used to read papers and, we was very inclined at how do you get the next big multi-bagger, right? And I gave him a couple of ideas. One of them, became almost more than 100x in the subsequent year, in 2 years. So I recovered more than 10 lakh that I'd lost. And that's how I've kind of, since that time, been much more focused on investing. rather than day trading as such. So, and obviously now our profession itself is so much regulation around us that we can't do any day trading, neither in our funds, neither in our personal capacities. So you only do long-term investing.
And that's quite an interesting story there.
You started in the equity markets during the global financial crisis of 2008, and you worked with various institutional organizations like Edelweiss before joining Motilal Oswal. So, what were the key learnings which were learned during this early stage of your career?
Yeah, so I think quite a bit of them, right? So I actually opted out of my campus placement. I was the only student who said I will not do campus placement because first of all, my MBA got over in 2008, which was probably not the best time to move out for a job as such. And I think everyone in my batch got placed, and I didn't opt it because I was very clear I want to do equity research, right? So I said that if there is no equity research company coming, I'll not do it. So I started doing cold calls at that time. I used to call, used to take numbers from website. At that time, Edelweiss, Religare, Motilal Oswal used to be there. And I used to keep calling. And most of the places, there were no hiring. There was complete hiring freeze at that time. And only in Religare, there was a place for someone who can do charts. So, in a research report, there are charts, right? Macro charts, right? So I told him that you please give me a job. I will do charts because I was very clear I have to get into the system. If I get into the system, I will work hard and I will show my talent. And if at some point of time, if I get an opportunity, I will start covering sectors, right? And that's how I got into charts and I started doing macro charts. All those large macro report that you generally used to see is what I used to do. But one thing which was quite different at that point of time is I was very inquisitive about how research is done, right? And I wanted to understand every, small bit of how research is done. At that time, my boss, was very, very kind enough. And he said, okay, doing macro research, till 5 o'clock, 6 o'clock in the evening. After that, why don't you read the reports and I'll, you help me wherever I feel I need your help. And that's how I used to work till 6 o'clock on whatever profile used to be. And from 6 till night 11, I used to read research reports and, learn and grasp myself that how do you write a research report? What line of thought process is there in writing a research report, so on and so forth. And then looking at that, my boss said that, there's, one day the security guy complained saying, boss, this guy he comes at morning 7 o'clock and goes at 11 o'clock. He's the last one to go. I don't know what the hell he's doing here. So my boss said, TK, yaar, let me speak to him. And he spoke to me. I told him that, look, I want to do macro research. That's fine. But I want to do mid caps because I like exploring newer businesses and understanding business models. So he said, TK, since you're so keen, I will move to you to a mid cap research team. So I was the number 3rd analyst in that mid-cap research team. And at that time, my head of mid-cap used to teach me one thing, that always focus on business models, right? Don't focus on numbers. Don't focus on outcomes. First, focus on business model. Can this business model becomes larger, right? Is the size of opportunity large enough? Second, is there anything changing from a value migration standpoint? Like, so for example, if there's single screens, can that move to multiplex? What is the big value migration of those times, right? So that was a second learning that I had. So in that entire, duration of my stint with Religare, I only learned how to understand businesses, how to look at businesses from a longer term standpoint, and had very less understanding of financials or annual report, right? So that was my major learning out there. Then when I moved to Edelweiss, again, my reporting boss was an ex-Reliance employee, very, very sharp. He used to cover another product called annual report analysis. So under his leadership, I actually learned how to read an annual report. How do you analyze numbers? How do you do, analysis of cash flows, balance sheet, and P&L? Are they talking to each other? So we used to do a lot of the forensic analysis, for balance sheets of a lot of companies. And I learned from that team. And along with that, I used to do the mid-cap research. So the financial benefits or how to read a financial statement, how to understand financial, juggleries that a lot of companies used to do from time to time was learned at Edelweiss. So it helped me to avoid mistakes, right? I was able to find reading an annual report कि यार ये तो कोई इसका accounting standard क्या है, इसका depreciation policy क्या है, यार इसके पास गाड़ियां ही gross block में है तो उसके सामने repairs and maintenance नहीं दिखता है. So a lot of those basic channel checks we used to do from an annual report standpoint, and that kind of really helped me to develop that part of the equation which was weaker in Religare days, right? So in Religare, I got businesses. In Edel, I focused more on financials. And then I moved to Motilal Oswal as head of midcaps, and we had both understanding of both the worlds, right? Which was quite unique. And then in Motilal Oswal, our focus on the sell side was clearly to come out with ideas which no one used to cover, right? So that was a kick, that why can't we innovate stocks, or why can't we come out with research on stocks which can become multi-baggers for tomorrow? And we should be the first one on the street to come up with that, right? So there are a lot of names that, again, we covered at that point of time. Most of them have become 20, 30x over a period of time. So that was really the excitement. So I think these are three organizations which really made a significant impact in my career.
Niket, that's a very interesting backdrop that you've shared with us. With that in mind, we'd like to know more about your investment approach. So what kind of market environments do you find most exciting or opportunistic?
So I think, from beginning, I'm very, very focused on growth, right? Rather than value. I mean, I don't believe there's growth and value, but I think broader market does believe there's growth and value, right? So fundamentally, we like businesses where the size of opportunity is very, very large. I mean, the first starting point for me is size of opportunity. If there is no size of opportunity, then the size, then the companies can't become 5x, 10x, 20x over a period of time, right? For it to become 5x, 10x, 20x, I think the ocean has to be very, very large. And within that ocean, if you're able to become larger over a period of time, that's how you become larger. So for example, let me give another example. Air conditioning businesses in India, again, very large size opportunity appears to be from an outside. But if you look at the profit pool of AC businesses in India, is less than 1,000 crores, or maybe less than 1,200 crores, right? And that number has broadly remained in the range in the last 10 years, right? But if you look at capital good companies in India, the profit pool is very, very large, right? In north of 20,000 crores, 15 to 20,000 crores, give or take, right? So I think when you're looking at those larger size opportunities, right, then I think that the chances of you to find a multi-bagger is very, very high. Or look at tech companies, look at banking as a sector. The size of opportunity is very, very large. So that is, if you are able to get consumption, again, size of opportunity is very, very large. Some of the food delivery businesses of today, look at the GMVs that they're doing, right? In 3 years, they should be, about 70, 80,000, 1 lakh crore GMV. Anything is possible, right? So the size of opportunity is very, very large. So that is the first starting point. Second is the growth of the industry itself. Is the industry growing at a faster pace? Is the industry growing at 2 times the GDP bare minimum, right? And then within that industry, is the company that you're selecting or looking at is gaining market share, which means he's growing faster than the industry growth rate, right? And fourth is promoter, right? Very clean promoters, great businesses, bad promoter doesn't help. And bad businesses, great promoter doesn't help. You need a great business with a great promoter, right? And that's, I think, a winning combination to really focus on. And last but not the least is the whole forensic from a financial analysis standpoint, which is more focused on cash flows rather than P&L and balance sheet. Because ultimately, what really comes to shareholders in some sense is cash flows, right? So if there is companies which don't generate free cash flow or very high growth, it's typically a red flag for us. Unless and until they're in an expansion phase, or they're in a business where 2-3 years of massive capex is required to take to a certain level, and then there's a free cash flow. But we have to deep dive into some of those companies where there's negative free cash flow, which is quite important for us from a quality of business standpoint. So I think these are 4-5 things that we really focus on. And then earnings growth, right? We don't like businesses which grows at less than 25%. So essentially focuses on businesses which can grow at 25% over the medium to longer term from a longevity standpoint. So if you are able to get these combinations, which is quite rare, and that's why we run a very concentrated portfolio today. If you're able to get some of these, elements tick boxed, then we would definitely look at investing in that.
Niket, markets have been hitting new high for every week now. Do you believe these rallies can be sustained? And what are the factors which are driving this rally? And what could keep the market going up?
Yeah, so I think there are 2 things to when we look at markets, right? One is fundamentals and second is flows or liquidity. Fundamentals, if you look at the last 3 years, while everyone, probably this is one of the most hated markets where everyone thought that market has run up too fast. And this narrative has been in the market since a couple of years. But I think no one has really taken time to focus on earnings growth. Earnings growth for Nifty companies in the last 4 years is about 22% CAGR. For midcap has been about closer to about 40% CAGR, 38 to be precise. Say, let's say 40% CAGR. And mid-caps, small caps have been about 48%, or say 50% from a rounding off standpoint. So when you have these kind of growth rates, which we have never seen for mid-cap and small-cap companies since the time indexes formed, it's bound to happen that we will see material amount of re-rating in those stocks, right? And if you look at the returns of those index, it's actually mirroring earnings growth, plus or minus 2%, right? Similarly, if you look at liquidity side, there has been the biggest change on the liquidity side has been this retail participation, right? We are now, I think, closer to 16, 17 crore demat account statements from 3 crores. The share of retail in an overall market cap is now moved up materially. And I also assume, a large part of the mutual fund also is owned by retail, right, to some extent. So the mutual fund stroke, which is domestic institutional investors plus retail today is roughly about 85%. And FI, which once upon a time used to be 22, 23% and down to 15%, which is probably the lowest in the last 10 years or maybe more. So 85% of the market is just being more bullish and slightly more excited and keeps pumping in money. And the 15% keeps selling, right, to some extent. So when 85 keeps buying, 15 keeps selling has no impact on markets from that standpoint. And hence FI is selling, which once upon a time we used to look at the FI figure in the evening. FI ne itna bada maal becha hai, so obviously trend is changing. I think gone are those days. I don't even track FI numbers on a daily basis right now, right? Because I think the fact is that the retail has become very, very large, right? So I think these are the two things which have kind of ensured that the market continues to remain buoyant. And what we've started seeing in large cap move down to mid cap, small cap. Now we are seeing so much of passion and love for unlisted equities. So the risk taking ability of retail stroke HNI stroke institutional investors on the domestic side have only gone up over a period of time as the confidence has really kind of come through.
So you believe that markets are given the
So I think what we've now
fundamentals
seen, Chirag, is that last quarter was the slowest earnings growth in 16 quarters. We only seen earnings growth of about 4% for large cap and about 7-8% for mid caps. And it's the slowest growth. Now one can attribute that to elections, right? Which is possible. And hence, I think the second quarter earnings is quite a bit of a litmus test, right? If second quarter also we continue to see weak earnings growth, then I think market will start seeing some correction, some sell-off. We already started to see a lot of sectors where stocks have come off from the peak, where valuations are expensive, they have started to come off from the peak, right? And where there's no earning support, any which was down 20% from the peak. So our sense is that we will see consolidation. You have to churn within sectors and themes, which is quite important. Otherwise, it's very difficult to outperform across durations. So if you look at, we would also move out of certain themes and certain sectors, and we've gone to certain themes and certain sectors, and which has benefited us. Lastly, I think everyone has been saying that valuations are expensive and hence, market should correct. Markets don't correct because valuations are expensive. Markets correct when there's earnings downgrade cycle happening or anything globally going wrong, right? Just because valuations are expensive, markets won't correct. And valuations have been expensive for the last 18 months. It's just got expensive yesterday. It's gone last 18 months, it's been expensive. And from that standpoint, market is still continuing to rally. A lot of people who have left out, raising a large amount of cash last year are still going to suffer, right? And are still suffering because markets keep continuing to go higher. So I think till the time you have strong earnings growth, reasonable amount of liquidity, I don't expect market to fall materially. Having said that, what is just recently changing is some of the US data tend to become much more concerning, right? So a lot of US macro data is becoming concerning. At the same time, India is seeing slowdown in earnings, and hence we believe market will consolidate here, right? We don't expect a big rally in equity markets, but we don't expect a big correction either. We don't think markets are going to correct by 25%, right? Can you have a 8 to 10% correction? The answer is yes. If you look at 2004 to 2007 rally, which is a bull market that we all know of, there were 7 corrections, of which 2 corrections were close to 30% each. Yet that was the biggest bull market we all knew before this one happened, right? So I think what we have to keep in mind is that there will be sell-offs. In the last 4 years, we've not seen a sell-off. Can we see 8-10% correction? Probably yes. That's not a thing that I would rule out for. But that doesn't mean the bull market is over. I think we are in a structural 10-year bull cycle of India. I don't think we should say that the bull market is over and the market is going to crash and all of that. We don't make that prediction. I think we focus a large amount of time on individual stocks other than markets. But I think we strongly believe that like Japan had 1980 to 1989, like a golden decade where Japan's stock market went off the roof. You look at China from 2004 to 2014, they went off the roof. For India, it is 2020 to 2030. So I don't think till 2028-29, we will have any massive setback on equity markets unless something goes wrong globally.
All right. But like you mentioned, valuations being at record high. So is it getting tougher for you to find good investment opportunities? And how do you go about identifying value in this market?
Yeah, so I think at all points of time, there's value in the market, and there's mispricing in the market. That's why market exists. Our view is that you have to look at sectors where the valuations are reasonably cheaper, keeping earnings growth in mind. For example, our view is that IT growth will come back once US election is over, and for next year, you will see a big, what should I say, growth coming back to IT companies, right? Now, if you assume a slightly higher growth for some of those IT companies, then I think the current valuation would look much cheaper, right? And hence we took an overweight call on IT, few quarters back, and that's really benefiting us in some fashion. We took an overweight call on pharma some quarters back, that's benefiting us in some section. So, and what we have done, we've moved out of real estate, moved out of capital goods, we've moved out of some of the large beta sectors, right? Like banking, we've completely out of banking now. In fact, we have now 0% weight on banking, and some of the NBFCs is where our weights are very, very higher. So when you put your portfolio positioning in such a fashion that it's very, very sharply positioned, right? That it's, if you start having banks, if you start having IT, if you start having everything, then you would not be able to outperform this broader market, right? So we were out of PSUs, for example. We took a call that we don't want to have any allocation to PSUs given the run-up that has happened. So right now, as we speak, we have overweight on IT, overweight on telecom, overweight on consumer discretionary, and overweight on some of the manufacturing themes. So all these segments are structurally 20-25% earnings growth, right? That we are seeing right now. And hence we believe we don't want to take disproportionate risks, focus, dial upon quality on the portfolio. And there's enough and more opportunities available right now in the market. In fact, the last 2-3 allocations that we have done is on small caps, right? And they're up 60-70% in the last 2 months, right? So I think, while valuation is expensive, there is froth in certain segments. We should not, paint that brush to all the entire market. There is still a lot of value in the market, a lot of stocks that we continue to believe can give you 2 to 3x return in the next 2 to 3 years. And they're still available right up in front of our eyes.
Niket, since you look for the long-term investment, long-term calls in the stocks particularly, so could you just tell our viewers which are the sectors do you believe which can grow, which can hold for the next 1 decade, and which are the sectors which investors should avoid at this point of time?
Yeah, so I think one thing that you should avoid is all the high-flying sectors, right? Like the defense, capital goods. I think they have done exceedingly well, but the low-hanging fruit is already done, right? It's already extracted. So maybe they are not in a zone where I would say the risk-reward ratio is favorable, right? From that standpoint. So I would clearly avoid some of them. I would avoid real estate for sure. I think real estate had probably the best cycle post 2004, 2007. We have been biggest beneficiary of it, but I think we've completely played out the cycle as well, right? So from that standpoint, I would avoid both of them, at least for the near future to medium term. From an allocation standpoint, I think we focus a lot on themes. So I think consumer discretionary is one very powerful theme, which I believe over a period of next few years will continue to do very well. You look at what happened in China from 2004 to 2014, when per capita income went about $3,000. We saw material amount of increased growth rates in jewelry as a space, right? We've seen that with US, we've seen that with Japan, right? So jewelry is one big sector where if you have wealth effect created, you tend to start spending on consumer discretionary, which is more premiumization theme. Second important thing, which I think we continue to like, is IT. I think we believe with AI being around the corner, I think the kind of work that IT companies are likely to get, it will only add to that. I don't think it will subtract a lot of work. I think the fear is that like every Y2K, then cloud, everyone, during some of these large migration that happen, everyone used to say, "Bhai, Indian IT company band ho jayenge." But band nahi hote, they go from strength to strength over a period of time. So I think IT will be a sector to watch. And last but not the least is this whole mobile component ecosystem, right? Which we are very, very excited of. Large players like, likes of Samsung, Apple, Vivo, Oppo, all these mobile companies globally are now looking at India as a manufacturing hub. And that is just beginning to, just early days where, say $1 billion worth of products are being bought by Apple a month. Like Walmart, who are, say, sourcing $3 billion worth of product annualized, are now looking at a $10 billion kind of a target in the next few years to happen. And all these Indian companies are going to benefit out of it. So I think some of those things, and last but not the least is the whole energy migration, right? From fossil fuels to solar and wind. I think those sectors, I think, are again where we would continue to remain quite excited about the longer term prospects.
All right. And the new age companies, they have been making headlines. So what's your view on them? Do you think the retail investors should seriously consider adding them to their portfolios?
Yeah, I think you have to be again bisect and dissect. There are new age companies in insurance, newer companies in food delivery side, stroke, quick commerce side, and there are new age companies on the fintech side. I would avoid the fintech space, honestly, right? I think not very comfortable with the way lending is happening, and obviously there's asset quality risk and there's cycles to play for that, right? Something which doesn't have a material cycle to play is the consumer side of the business, where the size of opportunity is much larger than both the other businesses that I talked to you about, which is insurance and financial technologies or fintech as such. So I would say that consumer discretionary space is quite exciting. We are going to see more companies coming in that listed space. We have one which is already listed, but a couple of them will come as we kind of go forward. We believe that this is probably the biggest and the most powerful theme, at least in this decade, right? Where customers are willing to pay a fee for convenience, right? Which is like an Uber movement that we've seen with Uber. We've seen that with food delivery and quick commerce. And I think the size of opportunity is very, very large, and the runway of growth is very, very large. My sense is we've just scratched the surface in some of these businesses, right? There's a long way to go. If you have a 3-4 year view or a 5-year view, there's probably enormous amount of wealth to create it. And I think some of these companies in this food delivery space or quick commerce space, I would not be surprised in the next 5 years if they become top 10 companies from a market cap standpoint in India, and would create tremendous amount of wealth effect for people at large.
Quite interesting, Niket. Niket, when selecting stocks, what are some of the non-negotiable quality or standards that a company must meet to make it into your portfolio?
So I think first is promoters. I think business is run by promoters, stroke managements, quite important from a thought process standpoint, how they really look at businesses. And hence that brings to the second one, which is capital allocation, right? How do you allocate your capital in the business? So I think 90% of the time, or I would say 90% of the investing happens behind promoters, right? And 10% weight I would give it to businesses, right? Second, I think one is obviously capital allocation. Second is, return ratios, right? Third is cash flows. What I would say, second is cash flow, third is return ratio, which is quite important for us. And I think if you have, some of these things, size of opportunity, if these have 4-5 things that we generally tend to look at, if we are able to see, no major red flags, then we would go into investing in some of them. I think typically where we are seeing red flags is, some of the sectors where understanding is very limited in India. Let's take an example of semiconductors or say EV chemicals, right? Because when I browse through social media, I see so many people writing on EV chemicals as if they've struck gold. Fact of the matter is, if you look at China as a market, China is expanding capacities in EV chemicals, semiconductor chemicals, and bulk chemicals at a crazy rate, right? And some of the Indian companies will find very difficult to match Chinese prices, and hence have to depend either on government duty structures or their arbitrage. And business model which is built on arbitrage cannot succeed over a period of time and cannot create wealth over a period of time. And hence, I believe that a lot of people don't have knowledge of what China is doing, right? What the giant is actually up to. And right now, as we're seeing in some of these cases, like look at solar, look at EV chemical, battery chemicals, semiconductor chemicals. China is expanding capacity 2x every 6 months and is crashing prices and selling at 0% margin, right? Basically, it means that I want to gain market share. Till the time everyone is out of the business, I will ensure that I continue to lead this. And once everyone is out of the business, I will start focusing back on profitability. So we believe some of these newer businesses, wherever we look at, for us, global comparison is quite important. And people don't spend time on global comparison. Globally, kya ho raha hai ye cheezon mein? Because these are not localized stuff, right? Localized can be there. I mean, if you have a solar manufacturer and a government has a solar policy, and if you're an Indian guy only supplying to Indian market, great. You're likely to do very well because government is going to protect you. But the time you move out of the India, you look at US market or European market, there are arbitrage structures today where there's large import duty structures on, say, solar panels, which are imported from China into US. But what happens is the president changed and he said, instead of 100% duty, I want 25% duty. Then suddenly your business model collapses, right? So I don't think we keep all of these things into mind, and we do a lot of work on some of these global stuff. So for example, semiconductor is where we were doing some work, and I actually went to Singapore to visit a fab, right, which is a micron facility. Unless until you don't visit some of them, you don't understand the whole value chain, and then take a informed decision. So I think some of these things, like some of these hype that is created on some of these so-called thematic names like semiconductors and AI and all of that, I think we have to bisect and dissect, and there'll be few winners, but there will be quite a few of losers as well on the other side.
Okay. And Niket, on the flip side, what are some of the red flags, or when do you sell a stock?
Yeah, it's a good question. So I think we focus disproportionate amount of time on selling and not only on buying. And I think buying is overrated in India. I've been saying this in multiple forums that buying in India is extremely overrated. Selling is highly underrated. Selling is quite important, and I'll tell you 2 or 3 reasons why we sell. Right. First reason for us to sell is earnings downgrade cycle. If we believe the earnings downgrade cycle is going to start, then we don't want to own that stock. For example, you believe a company is going to grow at 30%. You realized 6 months down the line, 30 you're growing at 10%. Which means there's going to be 20% earnings downgrade, which means a PE of 10 will suddenly start to look much higher. And hence, obviously, stock looks much expensive from a forward earning standpoint. In those cases, we will, be a big, we'll be a fast and quick seller, and just move out of that name, right? So earnings downgrade is first thing, and hence that leads to valuation. Second, I think the reason to sell is if you get something else to buy, which can actually give you potentially higher return, right? So for example, just to give you some sense, in the last 1 year, mid-cap ITs have done very well, right? And within the mid-cap IT, the R&D companies have done even well, right? Now, small-cap IT hasn't done well and large-cap IT hasn't done well. And obviously, it's now catching up, but it's not done well. Can there be a time where at some point of time, you move out of the R&D names, which have done very well, and move to something else, say a small-cap IT or a large-cap IT, where growth is coming back? And there's earnings upgrade cycle, and in R&D names, there's earnings downgrade cycle. I'm just giving an example. So some of these things, how do you navigate within the existing themes, is quite important, right? So if you find a stock A, stock B, which is going to give you higher return than stock A, you will move from A to B within the same sector. So that is a second reason to sell a particular stock. So I think these would be the major 2 ones.
All right, now moving on to some fund-specific questions. So Motilal Oswal Flexicap Fund, it had a tough stretch from 2018 to 2022, but it bounced back strongly in 2023 and now into 2024. And similarly, the mid-cap and mid and large cap funds, they've also been stellar performers over the last few years. So what factors supported this turnaround? You did mention going overweight on pharma, IT, and some other sectors, but if you could elaborate on your specific sector calls that contributed to this performance.
So I think just going back to 2020 again, because that's where it all started. We went overweight on IT initially post-COVID because we had no idea what sectors are going to do well. But what we saw is IT doing very well because like you and me are chatting on Zoom. That time we all used to use Zoom and tech at home. So basic common sense was to go over with IT, which we all did. We made disproportionate return in IT. And in December 21, when we thought we relooked at the sector, we saw that cost to hai nahi, because everyone is sitting at home, no visa cost, no travel cost, and revenue is very strong. So margins were great. We thought that some of these things will change. Travel costs will come back, offices costs will come back, and top line growth will slow down, and hence valuation and earnings downgrade cycle will happen, and hence valuation was expensive. So we went from a significant overweight position to zero weight in IT in December 21. And we went overweight on banks and capital goods because we thought the country is likely to open up, right? And then banks did very well for the subsequent 1.5 year, where because interest cycle, you had a repo increase and almost 40-50% of loan book today is linked to repo rates. And hence banks and NBFCs all did very well, and there was lower credit cost in the system. So profit after tax growth for banks was quite exciting. And then, fast forward 1 year later, we exited banks completely. We went to NBFC. We thought interest cycle have peaked out. Now interest cycle can only go down over a period of time. When was very tough, but could go down over a period of time. And hence we wanted to be overweight on NBFC and also overweight on real estate, right? And this year, what we have done is, in the beginning of the year, right now we exited real estate. We went overweight on telecom. Now we have exited capital goods. We've gone back to IT and pharma. So that's how we've navigated this whole cycle. Right selection of the sector, within that sector, what stocks to buy. You book that profit, of that stock, and then move to the next sector or next theme, and within the next theme, what stocks to buy. If you keep doing this virtuous cycle again and again, then I think you will end up in a very good position. So that's broadly how we've kind of navigated this whole cycle in the last few years.
So Niket, you mentioned, after looking at the sector, you select the stock. So could you just elaborate, tell us, how do you select a stock if you are positive on IT or banking sector, for example, and how you go about investing in the stocks?
So I think, so let's look at example of consumer discretionary, or we can take example of IT also, but let's take example of consumer discretionary. You look at the whole consumer discretionary space, say there are QSR companies where the growth rate is challenged, growth rates aren't so high right now. There is negative SSG till at least till 1 quarter back. Last quarter, they kind of had flattish SSG as such. Growth rates are sub 15%. FMCG, no major volume growth. Again, growth rates are sub 15% or sub 10%, in fact. So that is kind of ruled out because again, it doesn't fit in a growth strategy, right? Then you move to jewelry. Within the jewelry, the leader is obviously slowing down because there was no competition in the past. And then there are number 2 or number 3 guy becoming a pan-India player, more aggressive with the franchisee option. And hence, growth rates for that company will become much higher than the industry growth rate or the leader's growth rate, right? Hence, that becomes a important element to look at. Then you have a food delivery business which was making losses, suddenly started to move towards profitability because of various unit economics changes that they did. And then suddenly you realize that instead of buying a QSR company or a restaurant business, why don't you go with the aggregator itself, right? Where the growth rate is 60-70% for the next 4 to 5 years, right? And then that became another exciting point where growth rates are very, very high. There are moats in the business, largely one guy winning market share, the second guy is losing market share. And it was a far more easier decision to take, right? So if you look at what we're essentially trying to do within that entire space of consumer discretionary or consumer consumption space, we are focusing on businesses which will grow at a faster pace for the next 2-3 years without diluting on quality and ignoring one or not investing in some of them where the growth rates are going to be far more lower than their past or some of the other ones. So while we know these other companies will also grow at 15% and their stock price will also go up by 15%, but I have 100 rupees to play. Of that 100, I want to invest capital in places where there is going to be very high growth or probably the highest growth of that sector. And hence, we fundamentally believe that companies which grow at 30-35% earnings growth also tend to see 30-35% price growth, assuming PE multiples remaining same, right? So that's why we keep chasing growth all times. And if you believe that some of these things where growth rates continue to be fairly, fairly high, and you ignore the one or have zero allocation to businesses where the growth rates are lower, you will end up in a very good position.
So coming to particularly the mid-cap fund, which has a history of investing into high-growth stocks, which is reflected in the portfolio piece. But considering that the mid and small cap has run up in the last few years, and showing the signs of overvaluation, how do you plan to manage this fund going forward?
So I think, as I said, obviously there is some froth in some sectors, which is clearly visible. Valuations are expensive, there's no doubt about it. But there are still some places where we continue to believe there will be earnings upgrade cycle, right? So IT is one of them, consumer discretionary another one of them. Within manufacturing, say wires and cables are very exciting, right? Where still demand is much higher than supply. So we continue to invest in those categories. Look at some of the retail businesses in India, right? Still growing at 70-80% mom and pop retail stores, business and they might be large cap in nature, but again, doing extremely well. So there are lot of spaces even today where earnings growth, in spite of the macro slowdown that we are seeing recently, are still growing at 50, 60, 70% plus, right? And we would love to stay along with them, right? Now, valuations obviously might look higher, but obviously the growth is also much higher. If you see a company which is growing at 60, 70% earnings growth and at 70 times multiple, I think the peg is roughly about 1 time. And generally, we've seen with the wealth creation study that Ramdevji had kind of articulated that if you buy a company with less than 1 peg or close to 1 peg, there's a good enough amount of chance that you will continue to outperform the broader market. So I think if you're able to get a high quality name with very high growth, it doesn't matter what the sector is going through, right? You will still end up making money. So if you look at from the last 1 year, we've been overweight on IT. It's largely mid-cap IT. Within mid-cap IT, only 2 or 3 names. And all those 3 names have given us 3x return, while index has not done anything great because large cap has been just languishing, right? So I think it's very important that never have a closed mind on anything. Keep your mind open. Don't get carried away by this valuation expensive. I mean, you have to keep it in mind that valuations are important. But just because valuation is expensive, people have just stopped investing, right? Or people have stopped looking at things constructively, right? And there are opportunities, there are newer themes which are about, like I told you about mobile component manufacturing, right? That's a very large theme. You look at a theme, like you look at GLP-1, right? Semaglutide, which is the largest drug in the world right now. And it's been quite a bit of a rage because it really helps in weight reduction. Now, that drug is going to go off patent in 2029, right? Now, can some of the large Indian pharmaceutical companies play a role? And within that, can there be, smaller companies playing a role, right? And then suddenly from that theme, if you think about, you will start seeing a lot of ideation coming from there. You look at what US is trying to do on CDMO. US is saying that, hey, CDMO, this act which they're likely to pass, hopefully post elections, gets over in US. Again, you will see a large amount of CDMO flows coming to India, given the capability that India stands for. So if you look at some of these newer themes which are evolving, right? Solar, CDMO, mobile component manufacturing, consumer discretionary. I think there are enough and more opportunities in Indian equity markets right now to go and play.
Right now, Niket, can you please elaborate at this point, what is it that's driving your enthusiasm in the IT sector? Like you said, your Flexicap and midcap funds are significantly overweight in the IT sector vis-a-vis their peers. So what is it that is driving this strong conviction in IT?
So I think, Ruchira, if you look at IT per se, went through a bit of a 18-month lull period, right, in the last 18 months. Obviously, everyone in US also thinks the recession is going to come, and hence, I think while the funnel of new orders is very strong, the deal closure has been taking time for a lot of IT companies, right? So that's number one. Now, what have we seen just slightly peculiar in some companies is, while deal closures have been taking some time, some of the mid-cap IT companies continue to do very well based on the macro tailwind that happened. Look at the auto ER&D business. Every auto company in the world is spending money on EVs or hybrid or any new technologies, right? So a lot of the auto ER&D companies are still growing at 25-30% compounded growth, right? Even, there is so much of slowness on the traditional IT services part of the business, right? Then there are some of the mid-cap IT companies which are the part of the IT services business. Within their IT services, there are products and non-product business. Say they are in product business. They continue to do very well, about 15 to 17% growth, lower than 25-30% growth that they're doing earlier, but still 15 to 20% earnings growth is a reasonable number given the context of the environment. Now we look at the tailwinds, right? After the 18-month of lull, as an organization for US, the major capex, right, is IT spend, right? They spend billions of dollars on IT. Right. And hence I say it's a capex for them and not an opex for them. For companies like us in India, it's a opex number. It's a chota number hai, as percent of sales. But for US, it's a very, very large number. Right. And hence I think for them, beyond a point, they can't hold back to that spend. Right. I think we've already seen 18 months of slowness in that sector. Post US election, I think a lot of this deal closure, which wasn't happening, is likely to happen at a materially accelerated pace. Right. That's the first point. Second point is AI. Now, look, after internet, if there's any big innovation, is AI. Now, AI can be used in the right direction, can be used in the wrong direction, and there are pros and cons of AI. Now, AI will take over some of the work for traditional businesses, like the BPO business will get clearly impacted. So if there is a company which is focused more on the BPO side, we would love to avoid that. But if there's a company which is not, any company which doesn't have a baggage of the original or the historical business, which will get impacted because of AI, then it's incremental business for that company coming because of AI. And we would love to invest in some of those businesses. So within AI also, everyone is trying to do on AI, but again, you have to really figure out who is ahead in the game, who is behind the game, who is much more. So look at, reports of Forresters, Gartners, and you realize that some of the guys are slightly ahead in the game on AI and doing cutting edge technology work. And my sense is that when you look at AI as a theme, what is artificial intelligence, right? For you to run an AI on your existing database, first you need to organize a database in certain format. Then that database has to go on cloud. And on cloud, once it goes on cloud, then you can run AI on it. So if you're an organization that doesn't have a data in place, doesn't have a cloud in place, but wants to do AI, you have to start level 1, level 2. So that is work incremental coming for IT companies, right? So everyone effectively have to move towards cloud. So that's more work coming through. And then on that, when you have an AI solution, which is again sector to sector different, then there is again more level of work coming for IT companies. So I would say that starting say Jan next year, IT companies should start seeing material amount of improvement in growth rates, and this trend should at least continue for the next hopefully 18 to 24 months.
Niket, coming to the ELSS fund, and not only ELSS, but most of the funds you run a very considered strategy. And if we speak particularly about the ELSS fund, then there is a high allocation towards the mid and small cap stocks. And given its run up, do you plan to shift the gear towards the other segments of the market?
So we have been doing that. If you look at for Flexicap Fund, ELSS, large and midcap, large and midcap is obviously regulated, but ELSS or flexi funds as such, we have been reducing our allocation to small caps, mid caps, and we have slightly increased our allocation to large cap. But having said that, we have not just tilted tides, 360-degree, right? We've moved up about 4 to 5%, 6%. We fundamentally believe businesses that we have in the mid cap side are again, 50, 60, 70,000 crore market cap companies, right? Very strong balance sheets. So it really doesn't matter, if mid caps had to correct. We still believe some of these mid cap or small cap companies where fundamentals are very, very strong, growth rates are very, very healthy, will continue to do very well across market cycles, right? So we don't want to, just because we believe valuation expensive will suddenly move from mid and small and move directly to large. I don't think that's going to happen. We will definitely reduce risk of the portfolio by moving more towards large cap. But yeah, the quality mid caps, we will continue to own it for the longer term.
Right now, Niket, it's interesting that in 2024, your ELSS fund had an 80% overlap with the large and mid-cap fund. With the recent changes in the budget affecting the ELSS category, how do you view the future of ELSS funds? Do you think they still make a strong case for investors?
No, I think it's become a slightly more tougher category. There's no doubt about it, right? But I think you look at from an investor standpoint, look at the amount of options that the investor has today, right? I think it's enough and more amount of options that investor has. Obviously, ELSS was one route. Obviously, post the budget, it's become slightly less lucrative. But I still believe that given the returns that India has to offer, a lot of other categories are going to see that benefit, right? So from an inflow standpoint, we have also seen, ELSS schemes inflows reducing, but that is obviously moved to some of the other categories.
Niket, if we recently Motilal Oswal launched the business cycle fund, and if we look at the business cycle fund and, for example, Flexicap fund, strategies remain more or less same, like investing into the businesses. So could you just explain us what is the key difference between both the fund, business cycle and the Flexicap fund?
So I think the only major difference here is that in business cycle is clearly we will have full flexibility to go 0% weight on certain sectors, because the theme itself says business cycle, which means that, for example, I'm negative on banking. I will have zero weight on banking, right? But for a large fund like Flexicap, I might not take that call. I will still have, say, 10 or 15% allocation to the BFSI space. It might be through NBFC, it might be through banks, right? So from that standpoint, the business cycle fund is slightly more aggressively positioned fund as compared to the Flexicap fund, which is more diversified and manages risk across cycle. Business cycle itself means that we will take very, very bold decisions on certain businesses or certain cycles of those businesses. For example, if we believe IT will do very well, we will have a 20% weight on IT. We believe telecom will do very well, we will have 20% weight on telecom. Right? If you believe banks will not do well, 0%. Capital goods might underperform, 0%. Defense, 0%. So those aggressive or very sharper positioning of portfolios on a very bold standpoint will be done in business cycle, right? So you will see as a fact sheet comes out, you will see that differentiation in the Flexi fund and the business cycle fund, that this is very, very boldly positioned, very, very bold calls versus a Flexi, which is, I would not say bold, but not as bold as business cycle.
All right, now moving on to the last conversation of this interview. So it's been a busy year for you with 5 out of 11 equity funds launched in 2024. So now with the upcoming Nifty 500 Momentum 50 Index Fund, do you think rule-based strategies are becoming more effective at predicting sector trends compared to traditional methods?
So I think we all have to give options to the investors, whether it's thematic funds, whether it is passive, active. I think we strongly believe we want to give multiple options to investors on narrower themes where they can, multiply that wealth, over the medium to longer term. right? And so that's why we are not launching some of these schemes on the active side, right? So what, like for example, if you look at a defense fund launch, has been more on the passive side rather than active side. We don't want to launch a narrower theme in the active side. We will launch a broader theme on the active side. For example, manufacturing theme. Now within manufacturing, for example, if I'm not positive on defense, I will have zero allocation to defense. But if I'm positive on wires and cables, I will have overweight position on wires and cables. So instead of some part of the manufacturing not doing very well or valuation being expensive, I can always tilt it to other sectors and still do well from a manufacturing growth standpoint. So it's quite important of how do you navigate through both of them, over the cycle, right? So that's why we will have much more broader themes being launched on the active side, and slightly more narrower themes being launched on the passive side. And I think customers have become very, very smart. Last year, when we launched a microcap fund on the passive side, everyone used to come and tell me, sir, is it a good time to launch the fund? Markets have gone up so much. You're launching a fund at this time. If the market collapses, microcap will get hurt even the most. But from that time till now, I think we're up more than 80-85% on NAV in just 1 year. Now, imagine everyone who would have participated in the journey would have made 80-85% return, right? So I think we want to give options to investors, from a standpoint, because they also manage their portfolios, right? Investors don't want to put 100% in business cycle or 100% in defense. For him also, it will be 5% of his portfolio allocation call, right? Where he wants to play the thematics, which is playing in the economy. And this theme-based thing is kind of running in India in a most prominent fashion recently. I haven't seen that playing out in the past, right? Because some of the themes that government is announcing today, so whether it's solar, whether it's EV, manufacturing, make in India, these themes don't die in 1 year. These themes last for 4, 5, 6, 7 years, right? Unless you see a change in government itself, right? So our view is that at least these themes will last for another at least 3 to 5 year standpoint. And hence we would keep launching some of these tuck-ins and this is again based on customers, right? Whatever customers keep telling us, like a lot of people used to tell us, why don't you have a small cap fund, right? And we used to say that, well, let us first perform on our existing funds. The day we do very well on existing funds, we will have some right to come back and show our face and ask for money, right? And that's why when all our funds started to do very well, we launched a small cap fund. Now that is also doing very well. We launched a large cap fund. That is also doing very well. We launched a business cycle fund. That is also doing very well. We launched a multi-cap fund. So on and so forth, right? So we've looked at all the recent funds launched in the last, on the active side, all of them are first quartile, probably first or second rank across durations. And that gives us the confidence that the team is able to take care of those schemes and manage it. And, only when we believe that the team can handle it, we'll go to the next one and launch it.
All right. Well, with that, it's time for us to wrap up this chat. Thank you, Niket, for taking the time to speak with us. It was certainly a very interesting conversation. Thanks.
Thank you, Ruchira. Thank you, Chirag. Thanks for your time.
Thank you. Thank you, Niket.